Stocks not only go up, right? We're all learning this lesson right now. It has a little bit of this March 2020 feeling to it. So we see pictures and screenshots of margin calls out there. People are getting more fearful. So maybe we are at the bottom of this correction. Nobody knows. But the reason for it is actually a macro event. So in this video, I'm talking a bit about the reasons, of course, for this correction once again, but also about my portfolio, some adjustments I'm doing. And I'm talking about a couple of positions through, as well as some buys and sells that I made, and then kind of concluding like where this could be going and what to pay attention to. But first of all, let me thank our patrons, because as you may see, the video is a little bit better in terms of the quality. I finally invested some of the Patreon support that we are receiving into a new camera. So hope to continue improving the content that I'm putting out there, not only on the information side, but also on the visuals. All right, so it's all about inflation and technology stocks. I mean, my portfolio is mostly growth stocks and tech oriented, so it's not looking pretty out there, but it's not the first correction that I've been going through. So here are a couple of insights to share, how this is different maybe from past events, and how to think about this. So first off, the underlying issue is, of course, that we have been printing lots of money in the West throughout the corona crisis, and now the economy is about to open up again, and then nobody knows how this will result in inflation. So the thesis here is that people have like lots of cash at hand. They go out and want to buy stuff, for instance, want to travel, go to restaurants and so on, but there is not enough supply for all of the demands, hence prices will go up. Now these are unprecedented times. We have never been in such a lockdown. Nobody knows what's going to happen, and markets are kind of looking forward, and they're trying to anticipate what is going to happen. And if you look at this picture here, posted by Jurian Timmer from Fidelity, it really shows you the ideal 5-year inflation rate, which is around 2% averaging in terms of the tech valuations. So if inflation is around 2%, then we historically also see the highest valuations in tech stocks in terms of the PE ratios. So any environment that is either deflationary or too inflationary is actually bad for those valuations, and they are getting pulled back. And now it seems that the markets are not trusting that we can keep the inflation at 2%, and thereby readjusting the PE multiples or the price to sales multiples as well. So thereby growth stocks getting really smashed and hammered because they have those high multiples, whereas the value stocks, for instance, like Volkswagen or ExxonMobil and stuff like that, or banks, they are now less at risk here, because these are sustainable businesses that are not having lots of growth, but also their multiples are not as overextended as the tech stocks. Now yesterday I closely watched the Powell talk on the Wall Street Journal around like how is he going to deal with this macroeconomics. And clearly we saw after his speech like the sell-off continued in Nasdaq. So he was not pleasing the markets in terms of how he can cope with the inflation. He said though that he want to use all of the tools in order to keep it at 2% maximum. Currently we are actually below that. But it seems like the markets are just uncertain whether or not this can actually be true. Otherwise, we wouldn't see this steep correction here in both the tech world, on the stock and the equity side, and also on the bond markets with the increasing yields in the bonds and the sell-off of the bonds. So obviously, I have to take a look at my portfolio and see like how to adjust to this new macro environment and what can be done about it. And so I want to share a couple of things that I'm currently looking out for, and also like how I rate my portfolio stocks and the positions. So currently I think it's important to look at the valuations of the company and also at strong balance sheets and cash positions. Because the issue why the valuation multiples are getting lower is, for once, because of the discounted cash flows calculation, but also because there's a fear out there that the growth companies need to refinance their growth, and now as the financing rates are getting higher, it's becoming more expensive for them to fund their growth. So if a company actually needs debt in order to finance their future growth and actually maybe their survival even, that is bad, obviously, also for the stock price. Now with that, let's talk about some of the companies. So for instance here NIO, and if we're looking here for some perspective, for instance the 2020 crash was about a 60% drawdown for NIO. We had a couple of more corrections with minus 36%, minus 25% and minus 30% again. And now this correction currently is like from the very top to the very low so far, it's minus 43%. So a really volatile stock movement here, obviously by NIO. And I have just made my previous video on a first reaction of the earnings, and I don't think that the earnings are actually causing that. It's just maybe the sell-off on top of the earnings is coming basically on top of that. But fundamentally, this company is in a good position, in the best position it has ever been, with 6.5 billion in cash. It's growing 100% year on year. The earnings call had some question marks about how the chip shortage may actually influence this growth rate for this year. But so far, I think they will actually grow another 100%, maybe even more year on year. So the fundamentals are entirely intact here. However, what we also see, the big sell-off after the earnings was obviously because of the EPS miss, so the miss on the projected earnings by Wall Street. So NIO is not a profitable company yet. And that's obviously also a big problem in this current correction for stocks that are not positive on the earnings yet. Obviously, it puts more pressure on them than, let's say, a more traditional company that has positive earnings already. But the bottom line here is that the fundamentals are intact and NIO can just grow into this valuation and has now also a solid cash position, actually not even the worst debt position as well. So the analyst price targets haven't changed either. So they reiterated their buy ratings and at a pretty high level, actually around 70, 80 US dollar price targets. So yes, NIO is definitely beaten down right now here, but it's not one of those companies where I would say we should really worry about. More on that later, which ones I think we should worry about. So let's talk first what adjustments I have made to my portfolio and why. And I posted them, as always, in my Patreon network for the 10 US dollars tier and above. And this is where I post like more daily signals. And to sum it up in a nutshell, I sold companies of my portfolio on which I think they will have a problem if this environment is going to continue. And one example would be Virgin Galactic, or ticker symbol SPACE. The problem with this company is that they have kind of a weak cash position and that this kind of more of a concept stock. So I really like the idea. And I'm a supporter of those kind of orbital stocks and stuff like that. But in such an environment, the problem is for them that they don't have revenues and that this company has largely benefited from the overall markets with the high multiples out there. And now when it comes back to the fundamentals, this company will have a harder time to refinance and also actually grow into their valuations in terms of catching up with the revenues, in my views. I've also sold a company called Organovo, which is about 3D printing of organs. Same here, I really like the idea and the concept, but they have almost no revenues. The cash position is not really strong and so on. So I think they may actually go a little bit lower, possibly, if this kind of environment is actually to continue. If you follow my videos, you also may know that I have a position in Futu and Tiger Brokers and that they have run up more than 400% in the last couple of days. I started trimming both. And now I am disclosing that I actually sold off my Futu position entirely. The reason is not that I not believe in this company, but it was still holding up quite well at a really large gain there. And for me, this is a good way of taking some profits there, because I think for Futu, we are going into earnings. Both Futu and Tiger have shown that they usually sell off after earnings. And I think they are still in a correction, so they have run up so much. It's really highly valued and is actually getting close to my full 2030 valuation prospects there. So I'm looking to get back into that stock later on. Overall, I still think it's a fantastic company. But with this recent run up and given this current correction, that was just one place where I could get some liquidity in order to make new purchases in other areas. That being said, the correction in Futu may be mainly because of this recent run-up and because it's natural to have a correction afterwards. But on the fundamentals, the company is also in a good position in terms of being profitable now and stuff like that. So nothing to really worry about. But on the other hand, maybe at this high valuation right now and in this macro context, that's not a buy for me on the other hand, right? So that's just my 10 cents here. So by trimming some of these concept stocks or taking profits at some stocks that are high, I made the decision to purchase on other fronts. So for instance, I added more to SEP or previously HMI because I think, once again, this company is so low valued. It's a profitable company. It's a growing company. It's a good mix between kind of value and growth. And the funny thing is now that this company is starting to behave like a growth stock finally, in terms of it's really selling off quickly right now, which is strange to see, to be honest, to be really frank about that. It's strange because usually you would say that this is a almost mature company already in terms of the profitability and so on, and yet it's still selling off. So that's strange to see, but let's hope that it also behaves like a growth stock on the upside in the future. And here I just think that with this company, there can't be so much wrong because you had really bad quarters, the Q2 and the Q3. All this bad news is already out there, but if you watch my latest videos on SEP and HMI, there's lots of future potential on it, and I think over time this should just pan out once analysts are actually waking up through the addressable markets to the potential of this company and also, maybe adjusting finally their price targets for it. In my last videos, I also emphasized how I really like Baidu in this year, and also that it may have to go deeper first because it can go up again. But now I'm starting to buy more of this company because if you look also at the fundamentals, this company has $25 billion in cash on the balance sheet, so they don't need to refinance anything. And at the same time, they're really valued low as a kind of a value company almost because of their more traditional search engine business. But they have all of these prospects of future growth in the area of artificial intelligence, EVs, cities, smart home, and so on, healthcare. So there's lots of potential in this stock. So I'm feeling quite comfortable in building and extending this position right now. Although that being said, there could be a further correction also in Baidu. It's rated as a growth stock, as we can see in a recent sell-off, but maybe parts of that was also just the correction in the stock itself after this huge run-up. So it's possible that this stock may has a chance to actually holding up better in a high inflationary environment than other tech growth stocks. Now that's similar to the company Meituan, which I keep on adding on the dips, and Meituan is already profitable now. So you can see the hockey stick. They have reached the phase where they turn into growing their revenues and also the bottom line. They have a good cash position as well. So I'm not really worried about this company in the long run in the future. Although, once again, this is a tech company. Therefore, you will also see higher withdrawals, but also higher gains on the upside. But I am betting here on the chance that this one is getting better through a high inflationary environment than others. Bitcoin is actually quite saving my portfolio here right now. You know that in the last couple of months I've been shifting lots of my allocation towards Bitcoin, and so far it seems to be turning out well as an inflation hedge. It's not going down as much as growth stocks. However, it is a risky asset and it is a bet into the future, so they will have drawdowns as well. They can be quite steep, so don't see it as a risk-free asset. In my point of view, though, it's the perfect hedge to my portfolio right now. I like the idea. I understand where this could be in the long-term future, and therefore, now in this current phase, it really has helped my overall portfolio. Now, in line with Bitcoin, I also invested in the blockchain technology company called Axnet, or Xunlei in Chinese, and recently this one has also been beaten down a lot, but I bought more because it has a really good balance sheet. They have lots of cash. They said that they're going to buy back actually more of their shares, and I am expecting them to turn profitable this year. And so I think the good news is still pending on the stock, and along with Bitcoin, it possibly has some correlation there, although it's not owning any Bitcoin, so that's just a kind of a fake correlation here. But I'm not so worried about this stock, although it's very, very volatile. And it's also just a very tiny position. But in this terms of rebalancing, I've been actually diving deeper into this stock. That being said, just from a chart technical level, it doesn't look really nice as an entry right now. It looks like it has quite a steep fall if things turn sour. And on the other hand, I also haven't done or haven't finished my due diligence yet. I mentioned that this is just my first entry into this position, and usually I am building my conviction over time. But yeah, being transparent here, I bought more during this correction. Now let's sum this up and also have a little bit of a future outlook. So for once, be careful about SPACs, for instance, stocks that have just a growth story but not the actual revenues yet, or stocks that are highly unprofitable and have a low balance sheet, low cash position. I think if this kind of macro event is going to continue or staying like that, then those kind of companies will be the ones who have a low chance with earnings reports and so on to actually increase their valuation in the future. So I'm trying to not get trapped in those stocks. Now, putting out another idea that I have, which I'm not sure how to answer it myself. Maybe some of the commenters have an idea about that. But you know, as this channel is mostly about investing in Chinese stocks or stocks that have actually a big market in China, such as Tesla. I'm wondering like how this international relation could actually pan out in this certain environment. So we know I'm investing in those US listed Chinese stocks. So obviously they are traded in US dollars. The ADRs are in that currency. So it also is being affected by the local US economy and the macroeconomics to that. But on the other hand, most of the incomes of these companies is actually happening in China, and China hasn't printed as much money. That's why I have actually shifted a lot of money into Chinese stocks, to be honest, in the first place. And now, of course, Chinese stocks are beaten down just as the US counterparts, because right now it's also anyways just algorithm driven. You don't see much differentiation between the different stocks. It's basically just, all of the stocks come down at once. But I'm wondering, like, if this kind of environment is going to hold, will there be like a positive effect from the fact that these companies are actually getting CNY as their revenues and maybe a stronger currency as well, and maybe not having to face inflation within the country? So that would be interesting to see how this could possibly turn out and possibly be a hedge in the future. I could be totally wrong about it. I haven't finalized my thoughts, but just want to put it out there. Then I think lots of people are mixing this downward trend and correction up with a fear about imploding EV bubble. Of course, EV stocks have been under lots of pressure, but this is a macroeconomic event. And although stocks like Volkswagen are now at new all-time highs because they are perceived value stocks, that doesn't mean that the market are currently not believing into the terms that EVs are going to take over the world. I think the problem here is that EV stocks are, of course, tech stocks. So I would rather see Volkswagen actually growing into becoming a tech company if they demonstrate capabilities in the area of software, if they have a better EV lineup in the future. And Volkswagen is, in my views, doing a good job in trying to shift around here. So yes, this company may also benefit from this trend in the future. Although it's interesting to see that they are doing well right now in the stock terms, although they have lots of debt on the company side and still struggling with the cars that they're putting out there in the EV sphere and so on. So definitely a space to watch. Gonna do a separate video on that. And ultimately the outlook is now that we can either stay in this environment where growth stocks are not valued as high anymore due to the new macroeconomic change. And then there's nothing you can change about that, right? That means you need to find new opportunities in that space or wait until the macroeconomics change again. However, if you believe, for instance, Kathy Wood from ARK Invest, she's saying that, well, we're currently seeing actually the bubble in the bond markets burst. and that there is too much bearishness towards bonds, and also like a short seller thing going on around the bond markets, and that's actually causing the rates to hike and spike there. And at some point this will reverse, and then tech will be coming back. And she said that it's actually a good thing that now value stocks are, also uplifted. All of the boats are lifted up. Of course, tech needs to correct during that time. But on the other hand, this tells us that not only is the money chasing tech stocks, but it's also chasing other opportunities. And thereby, this reduces the potential of being in a bubble compared to the dot-com crisis before. So whether or not Kathy is right or not, I'm not the one to judge it. I can only say that I invest in those companies that I'm showing you here in the channel. Most of these companies are growth stocks. That means high volatility. That means lots of drawdown if things are correcting, lots of upside if things are going up. So whether or not this is a sustained reaction and we're gonna keep tech stocks low, I cannot answer this. But definitely have to adjust the portfolio to that. And thereby you see investing in stocks is obviously risky. You need a longer time span, and also you need to balance your risk and your portfolio. That is not always easy. And it's also really hard to time the markets. So I always say, and keep on saying that timing the markets is beating timing the markets. And thereby, I hope this was insightful for you, and stay tuned for more insights, more on the NEO earnings, on which I have some, I think, underappreciated aspects that I can show you. And then, stay tuned for more stock picks and what's going on with my portfolio in the future.